Dear NRIs, I know that most of you might be investing in Indian mutual funds, but did you know that you can hold mutual funds in DEMAT as well as non-DEMAT formats? Do you even know in what format your current mutual fund holdings are? Stay till the end of this video where you will learn why holding mutual funds in non-DEMAT form is better and how do you know whether your current schemes are in DEMAT or non-DEMAT format. Okay, so now that we know that mutual fund holdings can be in DEMAT as well as non-DEMAT format, the non-DEMAT format is also known as statement of account format. Now, there are several challenges with holding mutual funds in DEMAT format. Let me cover each of them one by one. The first is reliance on the broker platform. One of the most significant drawback of holding mutual funds in DEMAT form is your reliance on the broker's platform for transaction. Once the mutual fund units are converted to DEMAT form, you can no longer transact through RTA portals, MF Central website or AMC website for that matter. You are only left with one option, is transacting through the broker's platform. Second is getting a loan against your portfolio. Now getting a loan against your mutual fund portfolio is also difficult. Nowadays, taking a loan against your mutual fund portfolio is a very reliable option for many investors, as opposed to taking a personal loan or a credit card debt, as the loan against mutual fund portfolio come at only an interest rate of around 10%. Now taking this loan against a non-DEMAT form of portfolio is very easy and takes not more than 10 minutes. But in the case of DEMAT holdings, you will need a no objection certificate from the broker to pledge your mutual fund holdings in DEMAT format. The broker generally uses this as an opportunity to cross-sell their other personal loan based products. Third is additional charges. Now transacting through a DEMAT account can introduce additional costs like annual maintenance cost for the DEMAT account, per transaction brokerages and things like that. By contrast, holding units in the statement of account form gives investor the freedom. They can transact in the SOA form or through the broker's platform through multiple free platforms like MF Utilities, MF Central, RTA website and AMC websites, all of these at zero cost. Now there are some challenges with transactions also. Starting an STP or an SWP might be more suitable for your investment strategy, but many brokers don't allow you to do this on their transaction platforms. Also, on the estate planning issues, mutual fund holdings in DEMAT format can have only one holding pattern and nominee structure across all the schemes. But in non-DEMAT format, you are free to hold some mutual funds in single holding nature and some in joint holding nature. Also, you are free to decide if you want only one nominee in a particular scheme or you want more than 2-3 nominees in some other schemes. Now, before I help you find whether your holdings are in DEMAT or non-DEMAT format, I would humbly request you to subscribe to our channel right now. I see many of you who view my videos don't subscribe to the channel, and the rising subscriber count is one of the biggest motivation I can get to keep on creating good content for all our NRI viewers. So how do you know whether your holdings are DEMAT or non-DEMAT form? So coming back to the topic, how does one know whether their mutual fund holdings are in DEMAT or non-DEMAT format? The way is simply log on to the MF Central website, where you can see if your scheme's holdings are in DEMAT or non-DEMAT format. So investors who prefer the flexibility of transacting on multiple platforms may consider rematerializing their mutual fund units, that is, converting them back to the non-DEMAT format. The process begins with filling out a rematerialization request form RRF and submitting it along with the other required documents to the broker. The broker then forwards the request to the AMC or RTA for processing the same. Once the request is processed, the AMC or RTA issues a SOA reflecting your holdings. The process may take a few weeks depending on the accuracy of the information provided and the AMC's processing time. While there are no charges for rematerialization, some depository participants or brokers may charge a nominal handling fee for this situation.
When it comes to investing in mutual funds, NRIs are generally confused whether to use an NRE account or to use an NRO account. Now, there's nothing good or bad in this. It all comes down to your particular needs. In a few conditions, it's best to use an NRE account, whereas in other options, NRO account is more appropriate. So let's discuss 3 key differences and understand what NRE and NRO accounts are. The first key difference is the purpose of the account. The NRO account is designated for NRIs to manage their income earned in India, such as rent, dividends, pensions, while the purpose of NRE account is primarily for NRIs to park their foreign earnings converted back to Indian currency. Secondly, funds in an NRO account are not freely repatriable. This means that there are restrictions on transferring this money abroad. However, up to $1 million per financial year can be repatriated out of your NRO account through your NRE account. Now, NRE accounts for that matter are fully repatriable. Both your principal along with interest can be repatriated without any restrictions. This makes it ideal for NRIs looking to freely transfer their money abroad. When should you use your NRE account to invest in Indian mutual funds? Now, if you're someone who earns abroad and sends money back to India, you have to invest using your NRE account. Similarly, when should someone use their NRO accounts to invest in Indian mutual funds? Now, if you want to invest your earnings earned in India, like your dividends, your rental income, your FD interest, in some cases, if you have withdrawn money from your older EPF or PPF accounts, which also comes to your NRE account, let's say you have sold a property, the money for that also comes to your NRO account. So in those cases, it's better that you make investments from your NRO account only. But make sure that one important point to note here is that NRIs are liable to pay TDS, which is tax deducted at sources on their mutual fund gains, and sometimes the TDS liability is slightly more than the actual capital gain tax. In such cases, you can use a lower TDS certificate for which someone who is a good chartered accountant and well versed with NRIs can help you. Also, one more thing which I want to highlight about the holding pattern. An NRE account can be held jointly with another NRI person, but not with an Indian resident. Whereas an NRO account can be held jointly with other NRI or a resident Indian also. Tax rates for equity-oriented mutual funds for NRIs are in the table below. As per section 111A of Income Tax Act, short-term capital gains on transfer of units before 23rd of July 2024 of equity-oriented mutual funds are taxable at 15%, and for transfer on or after 23rd of July 2024 shall be taxable at 20%. Again, as per section 112A, long-term capital gain tax applicable on transfer of units of equity-oriented mutual funds before 23rd of July shall be taxable at 10%, and on or after 23rd of July shall be taxable at 12.5%. Now remember, generally you will see that the TDS rates are same as the tax rates applicable for NRIs. TDS rates for specified mutual funds for NRIs, which includes debt funds, gold funds and bond ETFs. In case of gold funds or debt funds, capital gain on transfer of units of specified funds shall be taxable at applicable income tax slab rates, but unfortunately the TDS in this case is almost 30% for NRIs.